went to the Time 100 last week, and I came away so impressed. What he was talking about was a very realistic approach to the fact that regulation is on the horizon. He's not fighting it. He's kind of leading the whole effort, accepting reality. And the second thing is, what really I walked away, he's talking about Apple in the healthcare business. He's talking about whether it's the iPhone watch or whatever else he's got in mind, that we're going to be monitored in terms of our health, that we are going to know not just the simple things we have now as to how many stairs we walked up or how many feet we ran or what our heartbeat is, but he's talking about having an impact on our total health, which opens up a whole new area. And then you top that with, his revenues for his iPhone users is so large compared, for example, to an Android user. I just think Apple is, the market can handle 6 or 7% off for the year, for the quarter, excuse me, overall. He's got so many things growing for him. I wouldn't bet against Apple.
How long do you think it takes? I mean, we've grown up learning how to digest the cycle, right? The phone cycle, hardware cycle, watching supply chains. We got to retrain ourselves right now to understand margins on services, growth on services, things that he's talking about at the next 30 years.
Yes, but I think that same approach you just talked about is more applicable for the new IPOs and how we're going to adjust their growth rate from quarter to quarter and their earnings losses and how steep they are and what their number of users grows or doesn't grow from quarter to quarter and how those rates change. So I think we're in a new paradigm, perhaps, or a shift in focus. The focus is going to be on this enormous wave of IPOs that are coming out now and how the market is going to adjust on a quarter-to-quarter basis.
Well, given that, and given you have these companies coming to market who aren't showing any profits, in fact, they're showing massive losses, and they don't really explain how they're going to get to profitability, what's your take on this new paradigm, as you call it?
Duh. I mean, you have seen, I have to throw in one, I happened to look at a statistic yesterday, just by accident. The total market value of the entire New York Stock Exchange when I started, and we won't date it, was $300 billion for all 2,000 shares at that time. And we announced yesterday Microsoft's going over $1 trillion, and we have the 2 other trillion. 3 companies are $3 trillion compared to the entire. I'm sorry, I lost my train of thought. So we go back. Yeah, I think we are living in a very unusual environment. We haven't seen this since the 70s, as where companies can go public with huge losses that have to be funded, and the only way they're going to get them funded at the moment is through shareholder capital, because they're not about to turn the corner. I mean, there are a couple. I think Slack's in a good position. That may be why they're doing a direct listing, and they don't have to go through the whole normal IPO process. But, and I have nothing against any of these companies, and they've made a phenomenal success. I've said on this program before, I wish I were an investor in Uber, and I had kind of oblique opportunities, but Uber, WeWork, I met with Adam Newman. We have to see how they're going to keep funding these losses.
Uber wants to be the Amazon of transportation.
No. They want to prove that they can lose, they can fund a lot of losses up front, just like Amazon did. I don't think.
But they also want to. I mean, they're branching out into Uber Eats. It's in the way that Amazon was a discount bookseller at the beginning, and is far more than that now. Uber has aspirations here. Can they make that happen, or are they, at this point, are they too big for their britches?
Well, I don't know. I think they're probably smart, reflecting the slowing growth rates that they're seeing in the ride-hailing business, and the competition is going into a couple of other activities, and they seem to be doing very well in Uber Eats, but there's competition in that area also.
Sure.
I think, if I were a new issue investor, I'd be carefully watching and seeing what growth rates happen in the very early first quarter, second quarter, third, after they go public, because investors can get squeamish so fast. I mean, and people lose interest, and then all of a sudden your stock is, wherever. Yeah. I mean, look what happened to Lyft.
Right, exactly. Well, we know that, to your point about the new issues, investors are hungry for yield, hungry for secular growth. So tying it back to Apple, just to put a period on it, how does Apple make themselves look compelling in that environment?
I don't think Apple is going to spend any time comparing itself against any of these other companies. Apple is in a more established part of a portfolio strategy now. People are buying all these new issues, are possibly buying to flip at a fast appreciation, and I think they want to be, they want to mark their portfolios and show that they're in the latest, greatest. That has a lot to do cosmetically, attracting people to funds. And I think that we're going to be in a period of volatility in IPOs. I mean, they're not all going to go up, and they're not all going to go to dramatic premiums. One thing that's very interesting, though, a lot of the companies that are going public are almost household names,
right?
Whether it's Slack or WeWork or Uber or Lyft or Pinterest, and that's an interesting point. Even beyond meats, which I think is kind of interesting.
Huge.
The Impossible Burger will probably be coming right after it, but that's an interesting trend.